Stop scrolling. I need 2 minutes of your time before you look at another price chart today, because there is a number sitting inside the COMEX Vault report right now that the financial media has not touched. Not because they missed it, because explaining it would require them to explain something they have spent decades carefully not explaining. And that thing, that one structural fact about how silver is actually priced and stored and promised in this market, changes everything about what the number on your screen right now actually means. Today is Tuesday, April 28th, 2026. Asian guy here. And as I'm recording this, silver is trading in a range that would have been called impossible 2 years ago. Gold is holding above levels that central bank economists are not publicly discussing, but are privately terrified by. And underneath both of those prices, inside the actual mechanical plumbing of the exchange system, something is happening that is not a rally. It is not a correction. It is a structural fracture developing in slow motion. And the COMEX Vault numbers released this week are showing it with a clarity that I have not seen in years of watching this market. Now, I know there are two kinds of people watching this right now. The first group is already positioned. You have your physical metal. You have your mining exposure. You watched this market run. You watched it correct. And now you're sitting here asking the only question that actually matters. Is this move real, or is it another paper squeeze that gets reversed the moment the institutional desks in New York decide the trade is over? The second group is watching from the outside. You've been hearing about gold and silver for a year. You've watched the price move and wondered whether you missed it, whether the easy money is gone, whether jumping in now means buying the top. Both of those questions deserve an honest answer, and the vault number I'm about to walk you through gives you that answer, not in the form of opinion, but in the form of arithmetic. Let me start with what registered inventory actually means, because this is the term that separates the people who understand this market from the people who are just watching the price. When you hear that COMEX has X ounces of silver in its vaults, that number is not one number. It is two very different numbers that get casually reported as one, and the distinction between them is the entire story of what is happening right now. The first number is eligible inventory. This is silver that is sitting in a COMEX-approved vault, stored in the right bar format, certified and ready to be moved into the delivery process. But it has not been committed to that process. It belongs to somebody. That somebody put it in a COMEX vault for storage, maybe for convenience, maybe because they're a large institution that wanted proximity to the exchange. But they have not offered it for delivery against a futures contract. It is, in a very real sense, someone's private property that happens to be sitting in a convenient location. The second number is registered inventory. This is silver that has been specifically allocated and committed for delivery. When a futures contract goes to settlement and a buyer takes physical delivery, it comes from registered inventory. This is the stock that the exchange can actually point to and say, yes, if you hold this contract to expiration and demand your metal, here is what backs your claim. Now here is where the arithmetic gets brutal. The open interest on COMEX silver, the total number of outstanding futures contracts, represents an enormous notional quantity of metal. Each contract is 5,000 ounces. Multiply the open interest by 5,000, and you get the total paper silver that has been promised, bet on, and speculated around on this exchange. And when you put that number next to the registered inventory, the metal that is actually committed and available for delivery, the ratio you get is not a mild imbalance. It is a structural impossibility that is only sustained by the statistical reality that almost nobody ever demands delivery. Almost nobody, until they do. What the Vault report released this week is showing is that registered inventory has continued its multi-month drawdown. The metal is not being replenished at the rate it is being pulled. And simultaneously, the open interest remains elevated, meaning the ratio of paper promises to physical backing has not improved. It has widened. You have more paper chasing less metal. And that ratio, the leverage ratio of the COMEX silver market, is sitting right now at a level that, in previous cycles, preceded the most violent upside repricing events in the market's history. I want to be precise here because precision matters. I am not saying COMEX is going to default tomorrow. I am not saying the exchange collapses next week. What I am saying is that the structural pressure building inside this vault dynamic is not theoretical. It is measurable, and it is pointing in one direction. Now let me connect the vault number to what is actually driving it, because the drawdown does not happen by accident. Metal leaves registered inventory when buyers decide they want the real thing instead of the paper promise. And there are several simultaneous forces right now that are accelerating that decision for a growing number of market participants. The first force is industrial. Silver is not optional for the industries consuming it right now. Solar panel manufacturing requires silver paste at every cell junction. There is no substitute that works at scale. EV battery architecture, medical imaging equipment, water purification systems, advanced semiconductor manufacturing, silver sits inside all of it. And the companies building these supply chains are not speculating. They are not buying paper contracts hoping to profit from a price move. They are trying to secure physical supply for production lines that have contractual delivery obligations to their own customers. When an industrial buyer comes to the market and decides it needs to lock in physical supply rather than roll a futures hedge, it pulls from registered inventory. It converts paper into metal. And when enough industrial buyers make that decision simultaneously, which is exactly what happens when the price starts moving and procurement managers start hearing from their CFOs about supply chain risk, the registered inventory number starts falling fast. The second force is institutional. There are now several categories of large money that have made structural allocations to physical precious metals that did not exist 5 years ago. Sovereign wealth funds in the Gulf that historically parked reserves in U.S. treasuries are diversifying. Central banks in the global south that watched what happened to Russia's dollar reserves after 2022 are building hard asset positions that are not subject to sanctions risk or confiscation. Family offices that went through the 2020 to 2022 period watching every fiat-denominated asset get simultaneously inflated, are treating physical gold and silver as portfolio anchors in a way that was not common in the previous decade. This is not speculative positioning. This is buy and hold accumulation. Metal that gets purchased by a sovereign wealth fund building a strategic reserve position does not cycle back into the market during the next volatility event. It stays in the vault. It exits the float permanently. And every ounce that exits the float tightens the supply available to everyone else. The third force is the arbitrage. We have discussed in previous videos the premium structure between Shanghai physical pricing and New York paper pricing. That premium is not academic. It is a real-time signal to anyone with the capital and logistics capability to buy metal in the Western paper market and move it to where the physical bid is strongest. And the arbitrage flow that creates, west to east, COMEX vaults to Shanghai and Hong Kong and Singapore, is a one-way pump that does not reverse on its own. The metal that leaves New York vaults following the Shanghai premium does not come back. It feeds a physical market that is structurally committed to taking delivery. So when you put these three forces together, industrial demand pulling from registered inventory, institutional accumulation permanently removing metal from the float, and arbitrage flows draining COMEX vaults toward the Eastern premium, what you get is a directional pressure on the registered inventory number that has only one natural endpoint. That endpoint is not comfort. It is not an orderly adjustment. It is the moment where the ratio of paper promises to registered metal becomes impossible to ignore, even for the participants who have been deliberately ignoring it. Now I need to zoom out because the vault dynamic does not exist in isolation. It exists inside a macro environment that is, right now, the most precious metals-friendly backdrop in at least 4 decades. And the investors who understand why the macro and the micro are converging at this exact moment are the ones who will be positioned ahead of the move rather than chasing it. Let's talk about the dollar. The US dollar index has been under sustained pressure, not because of any single event, but because of a structural shift in how the rest of the world is thinking about dollar dependency. The weaponization of the dollar clearing system, using swift exclusion and reserve asset freezes as geopolitical tools, sent a message to every government on Earth that held significant dollar reserves. The message was this: your reserves are not truly yours. They are yours until someone in Washington decides they are not. That message was received, and the response, playing out slowly and structurally across dozens of sovereign balance sheets, is diversification away from dollar assets and toward assets that cannot be frozen, confiscated, or inflated away. Gold, silver, hard assets with no counterparty. This is not a fringe movement. The IMF's own data on central bank gold purchases shows a sustained multi-year trend of net buying at levels not seen since the Bretton Woods era. The countries doing the buying are not small players. They are the countries that represent the majority of global GDP growth over the next 2 decades. And they are making a structural bet that the asset they are accumulating will be more valuable, not just in price terms, but in geopolitical leverage terms, in the world that is emerging from the current period of realignment. Now layer on top of that the interest rate environment. The Federal Reserve's rate path has not resolved into the smooth descent toward normalization that equity markets were pricing in a year ago. Inflation has proven stickier than the models predicted. The service sector inflation that the Fed cannot easily control with rate hikes, wages, healthcare, insurance, rent, has persisted. And the political pressure to cut rates, coming from a debt-financed federal government that is spending hundreds of billions of dollars a year just on interest payments, is creating a situation where the Fed is caught between 2 bad options: cut too early and reignite inflation, hold too long and trigger a recession and a debt spiral. Neither outcome is good for confidence in the dollar. Both outcomes are historically positive for precious metals. And then there is the fiscal picture. The US government is running deficits that, in previous eras, would have triggered a bond market crisis. The only reason they have not is that the dollar's reserve status has, until now, created essentially unlimited foreign appetite for treasury debt. But that appetite is changing. Japan, which I have discussed before, is being forced to manage its own bond market in ways that limit its capacity to absorb US debt at the historical rate. China has been a net seller of treasuries for several consecutive years. The buyers who have stepped in to fill that gap are domestic, which means the Fed is increasingly the buyer of last resort for its own government's debt. This is not a stable equilibrium. It is a delayed crisis. And when the reckoning comes, when the bond market finally demands a real inflation premium, the move in precious metals will be fast and large. Let me speak directly to the investors who watched the correction and are now questioning whether this market has a ceiling. Because this is the conversation that matters most right now, and it is the one that most YouTube channels covering precious metals are getting wrong. The correction we went through was not a signal that the bull market is over. It was not the market telling you that the fundamentals had changed. It was a paper market doing what paper markets do when speculative positioning gets extended and momentum exhausts itself. The longs ran ahead of the fundamentals. The price got ahead of where patient buyers were willing to step in. And then the margin call mechanism, cold, mechanical, automated, cleared the excess positioning with the efficiency of a controlled demolition. What gets left after that kind of clearing event? The strong hands. The investors who were not buying on margin, who were not playing momentum, who understood the underlying thesis and sized their position accordingly. Those investors did not sell. They bought the correction. And the price you are watching right now reflects their activity. The rebuilding of a foundation on top of fundamentally driven demand rather than speculative excess. Every major bull market in precious metals history has included a violent mid-cycle correction that convinced a large number of participants that the move was over. The 1970s bull market had corrections that were terrifying enough to shake out investors who had been right about the direction but wrong about the timeline. Those investors sold, watched the price continue higher, and spent years calculating how much they left on the table. The structure of the current cycle is not identical to the 1970s, but the behavioral pattern of the participants, the euphoria on the way up, the capitulation in the correction, the disbelief at the base before the next leg, is recognizable to anyone who has studied the history of how commodity bull markets actually unfold. Here's the thing about the vault number I started with. It is not a narrative. It is not a prediction. It is arithmetic. Registered inventory is a measurable quantity. Open interest is a measurable quantity. The ratio between them is a fact. And the direction that ratio is moving right now, toward greater imbalance, toward higher leverage, toward a more fragile structure, is a fact that does not care about your opinion or mine. It is going to resolve. The question is not if, the question is when and how fast. So here is where we are. Tuesday, April 28th, 2026. The COMEX Vault report is showing a registered inventory drawdown that is accelerating. The paper-to-physical ratio is widening. Industrial demand is pulling metal out of the system at a rate that industrial production forecasts suggest will continue. Sovereign accumulation is removing metal from the float permanently. The macro environment, dollar pressure, fiscal deterioration, rate path uncertainty, and geopolitical realignment, is the most supportive backdrop for hard assets in modern memory. And yet, if you walk into a conversation with a mainstream financial advisor today and tell them you are watching silver and the COMEX Vault numbers, they will probably change the subject. Not because they think you are wrong, because explaining why you might be right would require them to explain the structural fragility of the paper market that underlies the pricing system they have built their practice on top of. That conversation is uncomfortable, so they do not have it. You are having it, right now, with the data in front of you. And the data is telling a story that has a direction, a destination, and a timeline that is not years away. It is in the structure of the market as it exists today. The vault number is not a headline, it is a countdown. And the investors who understand what it is counting down to are not waiting for the financial press to confirm what the arithmetic is already saying. This is Finance Guy. Like and subscribe if this analysis is useful to you. Share this with someone who is watching the price without understanding what the price is actually measuring. The chart is the exhaust. The vault is the engine. And right now, the engine is telling you everything you need to know.